The gap between the salary you negotiate and the money that arrives can be anywhere from 10 to 50%. Four things explain almost all of it. The gap between the salary you negotiate and the money that actually arrives can be anywhere from 10 to 50%. Gross to net in Israel is not one deduction, it is four, and understanding them explains almost all of it. The brackets, which are progressive, computed monthly and reconciled annually. The credit points, which are subtracted from the tax itself rather than from your income. National insurance and health tax, which are banded and stop at a ceiling. And the pension, which has been compulsory since 2008 and appears on your payslip as a deduction. One of those four is a credit that most new arrivals underclaim for years without ever noticing. Start with the one that is worth real money. Credit points, nekudot zikui, are subtracted from the tax itself, not from your taxable income, and that distinction matters more than it sounds. A deduction from income saves you your marginal rate on that amount. A credit point comes off the tax bill directly, so it is worth the same in shekels to everybody and proportionally more to people on lower incomes. In 2026, each point is worth 242 shekels a month, which is 2,904 a year. Every Israeli resident holds a base allocation of 2.25 points, and women hold 2.75. So who gets more than the base? New olim get 3 additional points during the first 18 months, 2 during the following year, and 1 during the third 3.5 years in total. A newly arrived man therefore holds 5.25 points in his first year, which is worth roughly 1,270 shekels a month off his tax bill. Then there are points per child, weighted heavily towards the youngest years and claimed by the parent, and that is the single most commonly underclaimed credit on an Israeli payslip. And there are further points for a completed degree and for military and reserve service, with the reserve credits restricted to qualifying combat roles. Which brings us to the mistake that costs people most. Points are not applied automatically. Your employer applies what he has on file and nothing more. A new child, a completed degree, or your olim status simply not reaching payroll means you overpay every single month and nobody tells you. So file form 101 accurately when you start a job, update it whenever anything changes, and reclaim at year end. Refunds can be claimed retrospectively, which is worth knowing if you are already 2 years in. Then the other deductions. Bituash leomi and the health tax are deducted alongside income tax. The rates are banded with a reduced rate below a threshold and a higher rate above it, together reaching roughly 12% on the upper band, and they stop at a monthly ceiling. Employers contribute separately on top of what you see. What you buy with it is substantial and worth knowing rather than resenting. Health cover through your chosen kupat cholim, maternity pay, unemployment, disability, reserve duty compensation, and an old age pension. The fourth deduction is the pension, and it is not optional. Provision has been mandatory since 2008 at minimum contributions totaling 18.5% of gross, broadly 6% from you, 6.5% from the employer to pension, 6% from the employer to severance. One thing worth actively saying yes to. Many employers also offer a keren hishtalmut, which is a tax-advantaged medium-term savings fund. Where it is offered, take it. It is one of very few genuinely efficient savings vehicles available to an Israeli employee, and it is separate from both the pension and severance. Ask about it at offer stage rather than after you have signed, because it is part of the package and it is negotiable. And when you are comparing two offers, read gross against net rather than gross against gross. Two jobs with the same headline salary can differ materially once the pension terms and a keren hishtalmut are in the comparison. If you have arrived recently or are about to, there is one distinction to get right, because the two halves are often confused. New olim and senior returning residents receive a 10-year exemption from Israeli tax on foreign source income and capital gains under Section 14 of the Income Tax Ordinance. That exemption stands and has not changed. What has changed is the separate exemption from reporting that foreign income. It now applies only to people who became Israeli residents before the 1st of January 2026. If you become resident after that date, you must report foreign source income during the 10-year period, even where it remains exempt from tax. So if you are planning a move now, budget for Israeli tax filing from year one. So practically four things in order. Your points. Form 101 filed accurately, your OLI status actually reaching payroll, children, and any degree claimed. Your pay slip, check the points shown match what you are owed, understand the pension terms, and ask whether a keren hishtalmut is offered. Year end, if you did not work a full 12 months or had a month with little income, you have probably overpaid, so claim it retrospectively if you are late. And if you are newly resident, establish your date of residence precisely and engage an accountant before the first filing rather than during it. Work the payslip out first, then the borrowing ceiling, then the shortlist. Israeli lenders underwrite on net, not gross. Everything here is covered in more depth on the channel and in the written version of this episode. Take your own advice from someone acting for you and nobody else.